Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on some major macro developments that are occurring in the market right now. There's some pretty big shifts happening right now, so I want to cover these in real time with you guys to keep you guys up to date. What's going on some of these charts is pretty impressive and is going to have some major repercussions on the dynamic we've seen on stocks and bonds until now. So without further ado, let's get right into it. Before we dive into this video, I just want to take the time to ask for a like if you enjoyed this episode. There's lots of time and effort that goes into making and producing these videos and putting them out for free for you guys. So leaving a quick like and also subscribing to the channel if you haven't already, it is really appreciated. Now there's a reason that I've started this video off on this chart here. This is the copper to gold ratio, a very, very important ratio that we love to look at. I believe the investor who actually popularized this ratio was Jeffrey Gundlach. And the way this ratio is used is to give additional insight regarding bond yields, and most notably the 10-year yield, which is a very, very important component of the financial markets. And you can see I've added the 10-year yield on top of the copper to gold ratio, and you can see they follow each other very, very closely. They go down together, they go up together, and that's been the case since 2007. When you have big moves up in the copper to gold, it corresponds to big moves up in yields. And the reason this works is because copper is an industrial metal, and so it responds to economic growth very well. It rises when the economy is strong, and when the economy is weak, copper tends to underperform. Gold, on the other hand, is generally seen to be a good hedge against weak economic performance. When the economy gets weak, that's when monetary policy needs to get easier. It increases the odds of seeing policies like QE or stimulus, which increases inflation while keeping bond yields low, and that's good for gold. Now, why are we actually looking at yields? Why is this so important? And why is the copper to gold ratio actually going to help us? Because if we can find out where yields are going, first of all, we know where bonds are going, because bond prices are just the inverse of yields, right? And I can quickly show you that. I'm going to put TLT on top of this chart, and you can see TLT rises as bond yields fall. TLT falls as bond yields rise. So we know where bond prices are going, and we also know that rising bond yields have been the primary cause for the stock market to go down. This is what's brought valuations down and caused this panic in the stock market. It's been rising bond yields. Now let's take a look at what's happening on this chart. The way the copper to gold ratio is used is through divergences. When the copper to gold ratio is moving down while yields are moving up, intermarket analysis is telling you that growth is slowing and that you should be concerned about the economy, while yields continue to move higher. Now these can last for a while, right? It can last for a few months, but eventually you see yields come back to join the copper to gold ratio. So quickly take a look at what's going on here. You see since November, we've seen yields absolutely skyrocket here as we've had tighter monetary policy. We've had sustained levels of inflation, commodities skyrocketing. That's all contributed to rising yields. But the copper to gold ratio is moving down here. And in fact, it's accelerating down, telling you that the economy is weakening and that the economy cannot sustain these higher yields. A weakening economy automatically puts downwards pressure on yields because it cannot sustain those higher interest rates. It's too expensive to borrow and sustain economic activity. Now, again, these divergences can last for a while, right? So that doesn't mean that we should be just expecting this type of move straight away, but it definitely begins to give us a strong bias to the downside for yields. Now, this is something that we've been preparing for. Lots of investors are capitulating on the bond market right now, capitulating on treasuries, and it is still very much a falling knife, right? This is a very, very aggressive downtrend, and we haven't really seen true signs of this bottoming. And similar to a lot of setups that we have, we can be bullish on the anticipation of a better macro environment for this asset and position on the way down. Once the market environment does begin to turn and you see all of this economic growth slowing materialize, inflation clearly peaking, which both seem to be pretty close. We haven't seen true evidence that we're here and that we should be 100% confident that these two things should be happening, but we're definitely getting closer and closer to that point. And this could actually be an opportunity to buy some pretty cheap treasury bonds in an ideal market environment for this asset. So we'll be taking a look at this in more detail over the next few weeks under the stocks and bonds section of the website at Game of Trades, and also letting you know whether we'll be including treasury bonds in our model portfolio when we'll be adding all the new upcoming features on the website. And keep in mind that bonds have had a 37% drawdown from the all-time high. Now it could still continue, right? Especially considering the strong momentum we have here. But this type of massive drawdown in treasury bonds doesn't happen very often. So the stock market is one thing that we look at gameoftrades.net, and we like to have a very strong view on where the market is going, because that branches out into other assets and it makes us understand the market environment better. In order to understand the market, you need to understand inflation and economic growth, which is the base of understanding the entire financial system, the core elements of understanding the entire financial market. But there are lots of other opportunities, and the bond market is one of those that we're currently looking at to potentially add in that portfolio and to make consistent updates on this asset. So if you're interested in that, make sure to click on the link down below and check out our website at gameoftrades.net. Now, okay, so let's say bond yields do collapse from here and we see this massive move down in treasury bond yields. What does that mean for the stock market? What does that mean for the economy? Now, one way I like to look at this is by watching what's happening on high yield option adjusted spreads. Now, this is credit spreads. And what this essentially tells you is when credit spreads are rising, expanding very quickly, it means credit risk is increasing. Now, if credit risk is increasing, the risk of defaults is also increasing, the risk of recession is also increasing. And so it basically tells you that the market is getting more and more concerned about the state of credit, the state of defaults. Now you can see what's been happening very recently here. We've had this massive rise in credit spreads. Now, the reason this is very, very strange is because what's happened since 1997 is that credit spreads rise when yields go down, right? And you can see that happens every time. Yields move down, credit spreads rise. Yields move down, credit spreads rise. Yields move down, credit spreads rise. And this has just been the relationship that you've seen for the last 2 decades here, and is evidently very, very different to what we're seeing right now, where credit spreads are rising, but yields are also rising. So that's telling you that the number one concern for credit right now is rising yields. If yields begin to roll over, then perhaps we'll see credit spreads roll over as well. That's our current view on this situation. Now make sure to leave a comment down below telling us what you think. But if that is the case, if you do see credit spreads move back down, let's take a look at what tends to happen to the stock market when credit spreads are moving down. Stock market performance is good because you all of a sudden see a confidence return to credit. The market doesn't like to see credit risk rise. It doesn't like to see increased odds of default. What it loves to see is when this risk is declining. And so the correlation between credit risk and the stock market is astounding. And you can see this has been happening since January 2022. We've had the stock market move down and credit risk rise with that. But hopefully it gives you a better understanding of how different this situation is here to anything we've seen over the past 20 years. And the fact that this rise in credit concerns is not being driven by the same thing that we've seen throughout the last 20 years. So perhaps we should think about that and not let that catch us off guard. Now, that's about all I want to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button, click on that subscribe button. Now, in the meantime, I wish you good luck on your trading and see you next time.